Hey everybody, Tom Gentile. Welcome to our week 4. This is our bonus week, Optionetics and Tom's Trading Room. This is our Trading Essentials program. We do this a couple of times a year. If you have been joining me all month long, we've talked about calls, all about puts. We also did a session with an oil and energy report. And if you look back, I mean, oil's kind of slowly moving up, but it's starting to move in that direction that we want to see it in here since we started the beginning of the month. Also, week 2, we talked about spreads. We also talked about darknet. And a lot of you are excited with the darknet strategy that we showed you. And of course, last week, we were discussing, we were getting into money calendar. We were talking about, again, spreads. We did review. We did money calendar. We had 2 case studies, and I'm going to kind of share with you. We'll just go over overall where those 2 stocks are going and what our expectations are going forward. But tonight, I want to spend the bulk of the time talking about credit spreads and high probability credit spreads and what we call the layered credit spread. And with me tonight is Devon Pearsall. He is an expert and probably one of the best, most knowledgeable experts in this particular environment. Devon, good evening.
Hey, good evening, Tom. How's everyone doing this evening?
Man, everybody is excited for you to come in. We had a little bit of confusion tonight. I had put a bonus webinar on, and for some reason it was defaulting to March 14th, and you're going on tonight. And so what we're doing is we're actually doing your webinar now. We're still going to do an additional webinar in March for all of my Optionetics students, and I'm excited about that. We are, guys, going to do both. We've got our webinar tonight. We do have also a bonus we're going to do on March 14th, which is cryptocurrencies. And I'm going to be sharing a report with you as well. So we've got a report handout in 2 weeks. We'll talk about crypto and where I see crypto going, and something called a secure token, which is very important that you learn what that is if you're at all interested in where the rest of the world's going when it comes to digital transactions. But we'll be talking about that in a couple of weeks. Tonight, we're going to talk about credit spreads. Before we begin, just want to let you know this session is being recorded, and like all of our recordings, we'll get it out to you as soon as possible after the live event is over. If you have questions, if you're here with us live and you have questions, feel free to ask us. You can ask us right there in the chat box, and we'll try to answer as many as we can. And then, of course, if you happen to be catching this on the recording, you can email us any questions you have, support@tomgentile.com. All right. And then finally, the disclaimer you see on the slide, on the screen there right now. We put this up at every webinar that we do, and just want to make a couple of things clear. You can read it in its entirety. In fact, when we send you the recording, just pause. All right. But couple of points I want to make. First of all, stock and options trading has large potential rewards, but also large potential risk. The other thing I want to mention is that myself, Devon, Jay, everyone associated with Optionetics and Tom's Trading Room, we are here as, really to help teach you, all right, what it is we do. We're here as educators. We're not investment advisors. We do not give specific trading advice, and you obviously need a broker to trade with. Everything we're going to talk about tonight is in US dollars unless noted otherwise. All right, let's go ahead and get started. So I want to do a quick review of our last week's case studies with Google and McDonald's, and then we're going to get right into trading credit spreads. I don't want to spend a whole lot of time on last week. We've talked about reviews of calls and puts. We've reviewed spreads. We've talked about darknet. Last week, I spent a lot of time on the money calendar. And again, the money calendar, for those of you that missed us last week, this is something I've been doing for the last several years. We have a pending patent on this technology. I think it's that valuable. And what it basically does is it allows me to go out and look at millions of different patterns against the world's leading stocks. And we're trying to find patterns that are 90% or better accuracy going back at least 10 years. And what we do is we go within those patterns and we find the best day to buy and the best day to sell for a bullish trade, and the best day to go bearish and the best day to cover for a bearish trade. Now, obviously, what we also do is use calls and puts or option spreads to try to create that low risk, high reward scenario. And of course, we plan and we execute and we manage those trades. So that's our mantra: spot the opportunity, create the low risk trade, plan, execute, and manage. So I'll show you the two that we talked about last week. First one was Google. So if you go back to last Thursday, Google ended on a low last Thursday. That was on the 21st. And Google closed at around 11:05. And so as you can see from that day all the way through to today, there's about 20 points of movement in Google right now from last week to this week. The money calendar had this as a bull, right? It's telling us between the 21st and about 30 days going forward. So that puts us into around the 18th of March that we were looking at a bullish opportunity in Google. Well, the bullishness has already started to begin since last week, and we're expecting that to continue into mid-April. The other trade that we discussed was McDonald's, and McDonald's also, it didn't make the kind of move that Google did, but it's also not the kind of price tag that Google is. We're talking about maybe about $180, from about 181, let's call it, up to around 184. So a couple of points, but look where it's hit. It's starting to hit some resistance up there. We expect that's going to crush through that resistance and continue on to higher highs. Money calendar says that at least 90% of the time that's been the case for the next 3 weeks. So we're excited about McDonald's as well. I mentioned that you could take a look at our software. We had a free 7-day test drive on Money Calendar, on Darknet, all of our option stuff. All you had to do is go to tomsoptiontools.com, see it right there, tomsoptiontools.com, and take the 7-day free trial. Also, we offered a special up to all of you for an annual subscription price. And we've been there's been quite a few people that have signed up for that as well. What we're doing is we're actually including our apps, and I've got some other stuff I'm going to talk about. I'm going to talk about cryptocurrency, like I said, in the middle of March, and I'm going to talk about Tom's option tools and how they relate to cryptocurrency. So you're really going to love this, because I think we're the only guys on the planet that offer the kind of tools we do for cryptocurrency. I believe we're one of the few out there that do it in the field of stocks and stock options. But now we've got this whole expanded grid for cryptos, and we'll spend some time on that in a couple weeks. All right, so before I turn this over to Devon, I wanted to show you guys the overview of Money Calendar. I want to give you an idea of what I'm thinking about when it comes to directional trading. This is the calendar for March. This is the only month the entire year where everything looks green. So you look at March 1st, which is tomorrow, and then you've got a full week, which ends on the 8th, a full week that ends on the 15th, a full week that ends on the 22nd, and a full week that ends on the 29th. And in every case, every single day, we have more bullish opportunities than we do bearish, which means I'm going to be leaning into the bullish side of any directional trades that I'm looking for over the next month. So we'll check back in on the 14th. And we'll see how that's going as we talk about cryptos. So at this point, what I want to do is I want to turn this over to Devon Pearsall, who's going to talk about high probability credit spreads and how you can actually trade them delta neutral. So without any more talking on my end, please welcome Devon.
Hey, all right. Well, hey, good evening, everyone. Tom, I'll wait for you to switch your screen over there.
I am pushing it your way as we speak.
Hey, it's amazing how fast the internet is, right? I've got
Compared
it.
Compared to 10 years ago, absolutely.
Yeah, no kidding. So, hey, anyway, good evening, everyone. Very excited to be here. As Tom mentioned, I love talking about credit spreads. So here's what we're going to do tonight. I know Tom already went over the disclosure statement here. So we're going to jump right into tonight's agenda. We have a lot of stuff to cover in a relatively short period of time. So the first thing we're going to do is just, I like to start all of my classes out with just taking a look at the markets, talking about the markets a little bit. we could spend the whole hour talking about, what the Dow, the S&P, and, other major markets have done. But we're just going to do a quick little overview on that. I want to tell you where I believe, as just my own opinion, nobody else's, not Tom's, not Jay's, nobody else's, my opinion on where I believe the markets are headed later this year. And then we're going to jump into some credit spreads. We're going to just touch on the basics. We're going to move into layering, talk about what layering is. I have some really cool examples to share with you, a lot of them. Examples that date back 10 years. Examples that from today, essentially. Well, not exactly from today, and you'll know why. Well, I guess I better give a short answer here before we move on. You're going to learn that I like to layer my credit spreads or open my credit spreads between 20 and 45 days to options expiration. And right now, we're not within that window, but I'm going to show you a very, very recent a few case studies as well. So we're going to do an overview of money management and then talk about what to expect in the upcoming March 20th Credit Spread Master Series coaching class. I know a lot of you are already registered for that 5-week program. This is going to be my last 5-week program that I do, so make sure to take advantage of that. So those of you that don't know me, just let me do a quick little 30-second brief introduction of myself. I've been involved in the markets for over 20 years. I used to manage a direct access trading firm. That is a politically correct way of saying I used to manage a day trading firm. Back in those days, I used to be a day trader. I used to trade a lot of stock, and it would not be uncommon for me to trade 20, 30, 40, sometimes even 50 times in a day. I got very good at trading money for money. I was also trading money and a lot of time to make a little bit of money. And one thing my father taught me years ago, he said, son, he didn't necessarily mean this with trading, but he just said in life, he said, learn how to work smart. Stop working hard and start working smart. And that always stuck in the back of my mind. And I got thinking, okay, what does that mean in the markets? I got to a point, really where I started off my trading career where, was successful, but I was trading a lot of time and a lot of money to make money. And that just didn't seem very smart because I wasn't able to do what I wanted to do when I wanted to do it. So over the years, I, really racked my brain and played around with trading futures and trading options and trading, a dozen and a half different option strategies, sometimes together. And, really kept asking that question, okay, how do I make the most amount of money in the least period of time, taking the least amount of risk? And back in 2006, I started to put together this layering system. I didn't know it was going to evolve to what it is today. It was not called the layering system back there. It was just trading credit spreads. And through some major market corrections like 2008 and 2010, this layering strategy has really evolved and done incredibly well. And that's what we're going to talk about tonight. So I want you to know, what we're going to jump into is not something that I came up with last week, or last night, or last year. This is something I came up with in 2006 and have been actively perfecting it ever since. So, to say that I absolutely love the strategy is an understatement. So let's start with the markets. All right, let's switch over here to Tom's tools, and let's just take a little snapshot here of the Dow. And anybody who's been watching the markets here recently know that it's been a wild and crazy market, right? I mean, last year it was, hey, what the heck's going on? We went from a correction into, some major pullback, territory, right? I mean, went from a correction on the verge of tapping into a bear market, right? So the difference between the two is a 10% pullback versus a 20% pullback. And now look at us. We're like 1,000, just a little over 1,000 points from the all-time high. We're above the 50-day simple moving average. We're above the 200-day simple moving average. And just by looking at, those two facts there, the markets are bullish. But, where do I think the markets are headed? And let me do this here as I keep talking about the markets. I want to just show you this major resistance line up here at 26,951, right? That's the all-time high. We do have a little support here where the markets have bounced and shown a little support. We've also seen that as a resistance right towards the end of January. So where do I think the markets are going to go between now and the end of this year? Okay. I think, based upon my knowledge and research here, I think the markets are going to either go up or they're going to go down. I mean, other than that, I don't, I don't know what to tell you. In other words, I don't have a clue of what the markets are going to do moving forward. All right. Now, Tom, before everybody signs off here and says good night, I want you guys to think about this. All right. Okay. Please don't sign off. All right. I mean, honestly, I don't know where the markets are going to go. And to add to that, does anybody really know which direction the markets are headed? And, watching CNBC, I've been snowed in here for a few days. And so I've had the TV on quite a bit, working in my office and doing some other chores, and I've been planning, rearranging some of our slides for that March 20th class. And when the markets are up one day, the analysts come on and say, hey, this could be it. We're starting to break above this short-term point of resistance up here at, 26,250-ish. And we're going to crack a high, and this is just a minor pullback, and we're going to look back, and it's going to be a blimp. We're going to Dow 30,000. Here we come. And then the markets sell off a little bit like today, and the bears show up and start saying, hey, well, this is it. We're coming up to a resistance area. We're going to roll over. We're going to head down. I mean, it is ultra confusing. I mean, to hear these bullish and bearish analysts come on sometimes within the same hour and talk about the same market in a totally different view, I mean, it has to absolutely confuse you, right? So let me ask you this. Do we need to know with a high degree of certainty where the major markets are headed in order to generate a consistent profit in the markets? That's literally the $1 million question, right? Do we need to know what direction the markets are headed in order to make a profit? Now, some are going to argue, well, yes, Devon, we do, right? And I will agree that with some strategies and some trading systems or investing systems, we do need to know which direction the markets are going, right? For example, in long-term buy and hold. Although there's also ways to hedge that, right, with other long-term vehicles such as bonds and cash and things like that help neutralize that a little bit, which is a whole nother conversation, very cool conversation, but a whole nother conversation. So even though I don't know which direction the markets are headed, I want to come back to this. Every example we look at, we're also going to look at what I call the flux factor, how much we can be wrong on market direction and still make a reasonable profit in the markets. Now, well, Devon, define what is a reasonable profit? Well, we'll get there. Okay, we'll get there soon enough, all right? So I just want you to start adapting a different mindset, or at least think about it, consider it, right? Because, I've taught a lot of these classes online, a ton of them live all over the world. And, it seems like this, a lot of our students want to find out, okay, how do I give myself that extra edge so I can figure out the direction of the markets? If I can just figure out that, then everything else will fall into place. And the truth of the matter is, folks, you're probably not going to figure it out, so stop trying. And I'm not saying give up. What I'm saying is focus your efforts somewhere else. Focus on how can I be wrong on market direction and still make a profit? Because at the end of the day, or I should say at the end of the tax year, right, do you want to be correct on your market analysis, or do you want to be profitable? I mean, that's really what it comes down to. And for me, you know what? I don't have a problem saying, yeah, I was wrong. I was totally wrong on market direction. I totally blew that one. But hey, guess what? We made a 28% return on our money. That's not bad, right? Or whatever. Okay, I'm just throwing out a random number. I'm not quoting any statistics. So that's the point I'm trying to get across. Okay. All right. So let's go ahead and talk about two different types of credit spreads. Right? We have bull put spreads and we have bear call spreads. Now, bull put spreads are semi-bullish, and bear call spreads are semi-bearish. Now, they say, or on the screen here, it reads, let me grab my little pen here as well, semi-bullish. Technically, we could position a bull put spread so it is or has to be 100% directionally based, or the markets have to move 100% in the upward direction in order for it to generate a profit. What we're going to do is this, and let's illustrate this. Okay, here's a basic chart. This is a chart of the Russell. Excuse me. We'll talk about why we're going to be focusing on the Russell here in just a few minutes. But let's do this. Let me grab my pen and see if we can't change that color here. All right, so on our bull put spreads, all of our bull put spreads are going to be sold or positioned below the current market price. And when we position those, we're going to use two different strike prices, right? We're going to sell a put option, and we are going to buy a put option. Now, the combination of the selling put and buying a put is going to create a credit, or it should be called, it's going to create a maximum profit, the maximum amount of money that we can make. Now, on our bear call side, what we're going to do is also sell two options. We're going to position two options. We're going to sell a call option, and we are going to buy a call option. Now, I want you to notice the position of where these sold options are at. By the way, if you've never done this before, you're brand new to trading credit spreads, this is a great screen to take notes on and write down, because the basic construction is we're only going to sell puts below the current price. We're only going to sell calls or call spreads above the current price. Now, what this allows us to do is create a maximum profit or a credit, for example, on the put side of whatever amount of money, let's just say 5%, and the markets can fluctuate down towards that sold strike price. Okay, all the market has to do is stay above this sold strike price in order for us to make that predetermined amount of money. Now, same thing on that call spread. All the market has to do is stay below this predetermined sold strike price in order for us to make whatever that credit or maximum profit is. So let's take a look at this. Let's switch over to the tablet computer. When I teach my classes, I love using the tablet computer. Just helps further illustrate these points. So let's say that we have a market stock, doesn't matter what it is, $47 per share. We're going to create a bull put spread by, for example, selling a $45 put option at a total cost of $4. Then we're going to, here, let me correct that. Those L's got kind of blurred together there. We're going to buy a $40 put option, let's just say for $3, okay? So the difference between 4 and 3 is obviously $1. Now, if we're trading, let's say 10 contracts, right? $1 times 10 contracts, which is 1,000 shares, equals a $1,000 credit, right? Or maximum profit. So as long as this stock stays above this price of $45 per share between now and options expiration, which the expiration for March is March 15th. So let's just say over the next 2 weeks in this example, then we'd get to keep that $1,000 profit. Now, of course, the other question is, hey, Devon, what happens? What happens if the markets go below $45 a share? Right? What happens then? Well, if you do nothing, you're hosed. Right now, this is probably why a lot of you are here, right? How do we be proactive? How do we do something with these spreads if we're totally wrong and the markets go against us? Now, we're going to talk about that tonight. I'm going to show you I'm going to touch on some really, really cool techniques. You know, how would you like to be able to buy insurance on credit spreads, right? Wouldn't that be pretty sweet? Guess what? Before the night's over, we're going to do it. All right. Now, I mean, not actual insurance, but we're going to use a debit spread as a concept to hedge against credit spread losses. Now, I call them debit spread insurance policies because essentially that's what they are. Now, same thing on the call side. In this example here, if we want to create or turn this into an iron condor, which is just a fancy way of saying a bull put spread and a bear call spread open at the same time, what we're going to do is sell a $50 call option, for example, at $4. Then we would buy a $55 call option at a total price perhaps of $3, and that is going to give us a total credit of $1. We run the same math, and we're going to keep $1,000 in this example on 10 contracts. As long as this market stays below this price, $50, between now and options expiration. Now, this is some of the basic construction of the spreads. Those of you that are registered for the March 20th, it's a 5-week series class that I'm teaching, my last one. We have put together an options primer, which it's a little, I don't know, hour and a half, maybe 2 hours. Tom and I did a couple of years ago, that goes through these concepts more extensively, not only through the basics of spread construction and options, but also the basics on how to place orders as well. Open them, close them, adjust them, and so on. So, but let's talk about some probability, because we can take this spread, this 40-45 bull put spread, and we can position it wherever we want, right? If we position it further away from the money, further down in this example, we're going to make less money, but it's going to increase our probability. So, for example, let's take this same $47 stock, all right? Now, let's just use the short strike price. So we had that spread positioned at $45, and I'm going to illustrate that spread by a bar, okay? Let's just say that's a bar, because we're going to change this bar here in just a couple of minutes. So we have this spread here at $45. Now, let's just say, hypothetically speaking, okay, let's just say that it has a 25% return on investment, okay? Now, return on what, right? What investment? Well, when we open up a credit spread, there's a certain amount of money that we have to put up on the trade. Now, if we go back to the previous example, for example, with this 40-45 spread, I just went up to the previous page, right? The difference between these two strike prices, the maximum amount of money that we have to put up, or the amount of money, I should say, really, that we have to put up, is going to be the difference between these two strike prices, 40 and 45, minus the credit that's brought in, times the contracts that we decide to open. So in this case, we have a 5-point spread minus $1 credit, that equals 4, times 10 contracts, 1,000 shares, so we'd have to put up $4,000 on this trade. We'd have to put up, or essentially $4,000, hold $4,000 in our brokerage account. The broker does this for us in order to generate a maximum profit of $1,000 or a 25% return on investment. So that's the quick and down and dirty how that's how the math is figured out on that. Let me see if I can. There we go. Grab my other page here. So let's just say that we have the opportunity to make a 25% return on investment, which I just briefly showed you. And let's say, hypothetically speaking, that trade has a 70% probability. Okay, so in other words, we have a 70% probability of this stock staying above this price, right, 45, between now and March 15th, which is options expiration, or whatever options expiration we're trading. Okay, now, how do you figure out probability? Well, there's a couple ways to do this. We can use a really fancy software program like Tom's Tools to do this for us automatically, which is really cool, by the way. Or we can look at options deltas, which I'll briefly show you a little bit later tonight, and we can convert delta to probability. So there's 2 ways we can do it. We can do it the old school way. We can do it the new, fast, and easy, down and dirty way. So let's just say, hypothetically, I'm just making this number up right now. Please understand there's no correlation with anything that's on the board right now. So let's just say that this has a 70% probability. Okay. Now, is that a good trade? Somebody might say, yeah, I would take a 25% return on investment with a 70% probability any day. When I'm looking at credit spreads, I like to have very high probability, what I call goosebump trades. Okay, trades where I look at and say, wow, I mean, look at that. Why wouldn't you want to take that particular trade? Those are the types of trades that I'm interested in. So in this particular stock, right, we may have the opportunity to position a credit spread down here, maybe at a price of 40, right? So we would use perhaps the strike prices of 40 and 35, right? We would sell the $40 put. We would buy the $35 put, and that is going to create a credit. Now, this credit is going to be less than what the 40-45 was, okay? Because now if we create this, let's just say hypothetically speaking, this trade has an 8% return on investment, substantially lower, still outstanding, right? Has an 8% return on investment, but look at this. Now the stock at $47 per share. If we're wrong on market direction, which by the way, I have no idea what it's going to do, okay, right? We just talked about that. If I have this $47 stock and it goes down to 44, 43, 42, 41, I am still making an 8% return on investment. And if my return on investment drops, my probability, again, I'm just totally making this number up right now, it might go up to something like 90%. So our probability when we sell our credit spreads further out of the money, our probability is going to drastically increase. Okay? Our return on investment is going to drastically decrease. So the art of trading credit spreads is to come up with a compromise, right, where we can be happy with all of these numbers. Now, the average trader, the beginner trader, me when I was young and dumb, would focus on just the return on investment. Hey, I can make a 25% return on investment. That's what I want to focus on. Well, guess what? You only get to keep that 25% if the markets stay above 45 in the example that's on the screen right now. Okay, not necessarily a very good trade. Now, if we were able to make an 8% return on investment on that particular trade and duplicate that maybe every month, would that be a good system? Okay, now I'm hoping that you guys are shaking your heads yes, right? I mean, yes, because we could be wrong by a substantial amount and still make a reasonable amount of money. I mean, 8% and we could be wrong? Okay, so, hey, Devin, I got a question. This is all fine and dandy, right? And these theory numbers that you throw up on the board, but hey, how does this look in the real world? Because when we take a look at some of these stocks, you know, we're not seeing some of the numbers that are even close to what you're showing on the board. All right, that's probably because you're looking at the wrong markets. So let's do this. Let me switch over to back over to my slides, and let's go over here and take a look at some data. Now, what we're going to do is we're going to take a look at a chart of the Russell. We're actually going to look at 3 of them right now. I'm going to tell you this right now. The first one that we're going to look at is old. All right, the price of the Russell was $540. So this is like from October 5th. I'll just throw it on the board here. October 5th, 12 years ago. Okay, so now most instructors are not going to show you a trade from 12 years ago. They're only going to show you a trade from today. Okay, maybe last week or last year. Okay, I'm showing you one from 12 years ago. I'm going to show you one from 3 years ago. I'm going to show you one. I'm looking at my notes here. I'm going to show you one from 2 years ago, and I'm going to show you one incredibly recently. Okay, like the last couple of weeks. And the reason I'm doing this is I want to show you that regardless of what number you see on the right-hand side, these are all on the Russell. Okay, regardless of the price. Okay, some of them are at $1,500 a share, right? On the Russell, we're $1,575 right now. Here it is at $600. Regardless of the price, the consistency of the quality of the trade is the exact same. So what I'm showing you here, what I'm trying to, I guess, and convey in other words, is this is time tested, and this has been around for a long time. So I'm not just showing you some couple fluke trades that, you know, were really cool and you'll never be able to duplicate again. All right. Now, why the Russell? Okay. Why are we only going to be focusing on the Russell tonight? Why are we only focusing on the Russell starting March 20th for that 5-week program? The reason is this. The reason is, and I can prove it, and I do, between sessions number 1 and 2 in mid-March, is the Russell offers the highest probability trades that make the most amount of money taking the least amount of risk. Again, I can prove it. In fact, I do. In fact, it's your first homework assignment between week number 1 and week number 2. Now, I go through a little technique that I've learned a number of years ago on how to compare an actual one market to another market, compare them apples to apples. Now, the reason that we're going to go through this exercise is I want you to know without a doubt that the Russell is the absolute best market to put your money in terms of trading layered credit spreads. But more importantly, especially since this is my last class, I want you to have the tools and the education necessary. So down the road, 3, 4, 5 years, if let's say the S&P starts becoming more favorable and offering higher probability trades that take a smaller amount of risk and pay more money, I want you to be able to run some simple analysis and come up with conclusions so you can put your money where you have the highest chance of doing the most with it. You know, if we were teaching a live class, I would always, or I'd ask you, why are you here? I've done this a lot of times over the years, and sometimes students will say, "Well, we're here to gain a little knowledge and do something with it, and we're here to help our church out." And I'd always say, "You know what, baloney. You're not. You're here for one of two reasons. Okay, you're here to either listen carefully. You're here to either make money, or you're here to make more money." And that's how we see it, right? I mean, that's true, isn't it? Sure, you want to make more money so you can give a little bit to your church and help them out, which is great, right? You want to stop losing money and start making money so you can better support your family, right? So everything all those other goals come after the fact of making money or making more money. So if that's really true, which I honestly believe that it is, if that's true, then we need to approach our trading the exact same way, right? We need to put our money where we have the highest probability of making the most amount of money in the least amount of time, taking the least amount of risk. And this, by the way, is one of the reasons that somebody's got their phone unmuted there.
That was me, Devon.
Oh, no worries.
I was going to try to pick a spot to get this question in here, but go ahead and let me know when you're ready.
Give me just a second, and then we're going to look at some trades here. So, and this is one of the reasons that I love working with Tom and Jay is, Tom was just showing you some very high probability stuff with the calendar trading, right? And so what he's doing is the exact same thing on a directionally based. He's showing you where to put or where you have the highest probability of making the most amount of money in the shortest period of time, taking the least amount of risk based upon historic probabilities. So I really want you to think about that. I mean, with every dollar that you invest in the markets, whether it's a long-term buy and hold with the dogs of Dow or a mutual fund or ETF, exchange traded fund or short-term directionally based trading, or now layered credit spreads, start thinking about probabilities. Jay, go ahead with your question there, bud.
Albert asked a bit ago, in your example, the expected ROI is greater at 70% than the 90%. So why wouldn't you go with a 45-40 spread?
So the expected probability is greater at...
Well, he said expected ROI. You're saying expected probability. Do you want Albert to elaborate?
Okay, let me switch just over here. I'm a little confused, I guess, on that particular question. So the probability on, and I want to make sure that Albert understands here, and everybody, I guess, with what I'm trying to illustrate. So this 8% hypothetical return on investment, 90% probability was based upon this 35-40 spread, right? So kind of down here. And this 25% return on investment, 70% probability was focused on a 40-45 spread up here.
So it comes down to, again, he's looking at the profitability, 25%.
Oh, I got you.
Return,
yeah.
Versus you're saying 8%. And I think you're going to touch on, again, you're going probability over profitability.
So in other words, if we put this trade 1 and this trade 2, right, and we do a comparison, why would I choose trade 2 over trade 1? Essentially is what he's asking. And for me, I would choose trade 2 all day long because I don't like to lose money. So yes, my return on investment is lower, but if I can win a whole heck of a lot more, and we put this into a calculator and do some math, trade 2 is going to show up to be a lot more profitable. Okay, let's take a look at some real numbers, Jay. Let's take a look at some real numbers, because I mean, right now it doesn't mean a whole heck of hill of beans right now, right? I mean, it's just maybe what I'm talking about doesn't actually exist. All right, let's go take a look. So here's a chart of the Dow. Again, this is an chart of the Russell, old chart of the Russell. Okay, so we already talked about why we're taking a look at the Russell. So let's compare some various spreads. Here's a bull put spread using the strike prices of 530, 540. Now this has a 21% return on investment. So what we would do is we would sell this $540 strike price. We would buy this $530. Now, what I don't have on here is the actual individual pricing to gain that 21% return on investment. Okay, I'm just trying to simplify the slide because I'm going to have a lot of stuff coming up here. This particular trade, Jay, has a 78% probability. Okay, now that's pretty good, right? I mean, hey, if this market, which is priced at like $590, goes down to $540, we can still make a 21% return on investment. If this $590 market stays at $590, we're still going to make a 21% return on our money. And if this $590 market goes up to $1,000, we're still going to make 21% return on our money. So the market can move 2.5 directions. Okay, the 2 is sideways and up. The half is down a little bit, and we can still generate a really nice profit. These are real numbers, by the way, from 2005, a long time ago. Now, or not 2005, I think these were 2008 or something like that. It's old. Anyway, here's another spread. 500, 510, okay? Same market, same date, okay? Different strike prices. Now, we would sell the 510, buy the 500. These are puts again. Look what happens to our return on investment. It drops. But look what happens to our safety factor. Okay, this market at 590 can go down to 520. By the way, do the markets ever abruptly go down without warning? Okay, how many times late last year did that happen, right? It seemed like about every other day. The answer is yes. And we could still generate a really nice profit. Now, watch what happens to probability. These are real numbers, okay? 78% probability goes up to 87%. Now, these are good trades, Jay. I mean, they really are. There's nothing wrong with them, except for I wouldn't take them. But they're not the goosebump trades that I'm looking for. I'm looking for trades that I can position, credit spreads that I can position where I have a very low probability of losing money. Okay, take a look at this one. This is where I like to live, right down here, way, way down here. Look at the return on investment. It's only 5%. Now, what we would do, these are using the strike prices of 470, 480. We would sell the $480 strike price, buy the $470 strike price, and we can make a 5% return on investment. Take a look at the probability. It's 93%. Now, make sure I've got my black pen highlighted here, and let me take the pen out of the cradle. So we have a market of $590-ish, okay, pretty stinking close to it. We can position a credit spread down here at 480. Okay, so what's 590 minus 480? Now, this is not scale. This should be down just a little bit further. But 590 minus 480 is 110 points. Okay, I'm going to put OTM, 110 points out of the money. We can be wrong, Jay, by 110 points, and we can still make a 5% return on investment. Now, let's take that 110 points, divide that by 590 to come up with a percentage. In other words, Jay, we can be wrong by 23%, and we can still make a 5% return on investment in a little over a month's period of time. That's not too bad. That's not too bad. Now, do you guys like that? Okay. What are your thoughts on that? Just type some in real quick. And Jay, I know we have a lot of people on this call, hundreds. But Jay, I just want to kind of get some basic feedback on what some of the students are thinking right now, because I'm going to show them a couple more trades. Now, this, by the way, folks, is what I call the flux factor. Okay, we have a 23% flux factor. Maybe you want to call it a boo-boo factor, right? Maybe you want to call it 23% wrong on market direction. What the heck happened factor, and we can still make a 5% return on investment. Now, Jay, I started the class out and I said, hey, I want to tell you where I think the markets are going. Yeah, every year I have the same prediction. I don't know. Do I need to know? When I could be wrong by 23% and still make a 5% return on investment. Okay, let's take a look at some others, but I want to start incorporating.
Let me know when you want their feedback, Dev.
Let's do it right now before I get all fired up here on some more examples, Jay.
Good, looks good, sounds great. I like it. Winning is more fun, less relative stress.
That's, you know what, that's a huge component of it right there. You know, the winning for the psyche, right? You know, being right more than you're wrong. A lowered amount of stress is absolutely key. So here's another example here, Jay, back from 2015. Now, I'm just showing you one. I'm just showing the trades that I like here, okay? So we have a whoa, what's my mouse is going crazy. That's weird. We have a 5.8% return on investment, okay? Here's the actual credit here, and a 92% probability on the bear call spread. So you see the strike prices at 1,270, 1,280. We are selling the $1,270 call, purchasing the $1,280 call to generate a 5.4% return on investment. So now what we want to do, and this is going to create a combined return on investment here. Let's just round some numbers. It's greater than 10%, right? So we want the markets to stay between 1,270 and 1,030 for 31 calendar days. That's what we want the markets to do. So in other words, we want the markets to stay within a 240-point trading range, right? We take 240 divided by the current price. That is roughly a 20% or 20.5%. We'll put FF, right, for flux factor, right? We can be wrong, Jay. The markets can fluctuate over a little over 20%. And we could still make over a 10% return on investment. All right, so here we are. You're at a cocktail party, you're hanging out with some of your buddies, and they say, hey, you know, you've been through this class. Hey, what they teach you about the markets in terms of where do you think the markets are going to go between now and springtime? And your answer is now, I don't have a rat's furry behind idea of what the heck's going to happen. I don't know. And then you casually say, and I don't really care, because as long as the markets stay within this 20% trading range, I can sit fat and happy. Now, I just got goosebumps. I mean, just literally saying that, because, I mean, these types of trades, folks, they're not out there every day. Okay, they're not. But they're usually out there a couple of times a week, every week, and have been year after year after year after year on the Russell. And you might say, well, why don't more people do this? And I'll tell you why. Because most people say 5.8%, you know, that's dumb. But for 30 days, annualize that. Annualize that. What is that? That's, you know, let's just take 5 times 12 months. That's 60% in a year. Okay, I'm getting worked up here, Jay, and I'm trying not to get too worked up. If you were on my call from Tuesday, I've been recovering from a cold, and I literally lost my voice at the end of the presentation. So I'm sucking on a cough drop right now, and trying not to let that happen. So I'm not trying to raise my voice too much, but gee, I want to so desperately bad right now because this is cool, right? So here's another example, okay, from 2016. Now, Russell, you notice, by the way, the overall trend of the market's been down in this example here. So 44 days before options expiration, you looking at a bear call spread with the strike prices of 1140.50. So we're selling the 1140, buying the 50 on the call. For the same month, we are selling the 920 put, buying the 910, and that creates a 220 point trading range. So about the same as the other one, right? So regardless of whether the year says 2016, 2015, or 2008 or 10, whatever that previous example was from, the quality of trade that we're seeing is about the same. And that's one of the things that I love about the Russell. It just hasn't changed much over the years in terms of the trade integrity. So the problem with most credit spread systems is this, and this is kind of where I got started. All right, let's create problem solution here. You look at a market, you think it's going to go higher, and you trade 5 contracts. Okay, well, right there. This is going to represent a short strike and a long strike. You trade 5 contracts, and guess what? You're right. The market goes a little higher. So you think, okay, well, here's what I'm going to do. On the next spread, I'm going to trade 10 contracts. And guess what? You're right, the market goes a little higher. And on the next spread, you said you're going to trade 15 contracts. Guess what? Market goes a little higher. On the next spread, you say, hey, I'm going to trade 20 contracts. And guess what? The market goes way down. And when do you lose? The problem with adding contracts and taking credit spreads and trying to turn it into a directionally based system. Now, what I mean by that is only opening up one credit spread. Okay, only opening up a bull put spread and trying to predict market direction. The problem with that is when you lose, you're always going to lose with the most amount of contracts. Now, I'm not saying that trading 20 contracts is a bad idea. I'm saying trading 20 contracts the way that I illustrated on this screen is a horrible idea. Okay, so let me just kind of start planting some seeds for layering before we start talking about it, which is coming up in about 1 minute. If I want to trade 20 contracts, right, or 100 or 200, whatever, okay, if I want to trade a larger number of contracts, why don't I do something like this? Why don't I start by trading 5, okay, and then open up another 5 above the market? Now, essentially what I've done, for those of you that are a little bit more experienced, I've created an iron condor, right? I've created a bull put spread below the markets. I've created a bear call spread above the markets, right? Now, I've traded 10 contracts. And what would happen if the markets move a little bit for the next, let's just call it 7 or 10 days, somewhere in there, and I do this. I open up 5 more contracts on the bull put side or bull put spread side, and I open up 5 more contracts on the bear call side. Now, how many contracts do I have? I have 20 contracts. Now, what would happen if I'm wrong and the markets go down a little bit? I might lose on 5 contracts. What happened in the previous example on my slides when I was wrong? I lost on 20. Now, I'll tell you this, folks. Opening high probability credit spreads is incredibly easy to do. I mean, I could teach you tonight how to find a 92% probability trade that pays a 5% return on investment. They're not that hard to find. Very easy, actually. The tricky part is, and what makes a poor trader versus an exceptional trader is what to do when the markets start going down, right? Well, part of that answer is to diversify into different contracts. Okay, let me reword that. Okay, part of the answer is to layer different strike prices on the same market. Diversify risk at different strike prices. So when we are wrong, notice what I said. I didn't say if we are wrong. When we are wrong, we're going to lose on substantially fewer contracts. All right. Now, one more thing I want to touch on real quick. Some of you might, Jay, you might have some questions coming in right now. I mean, there's 4 spreads here. Aren't commissions a little bit more expensive? The answer is yes, they are, because we're paying 4 commissions instead of 1. Nowadays, right, most of your commissions are like $10 or less. So it's not really a factor, but I still like to talk about it because that question still comes up. Yeah, there is a few dollars being spent in commissions, literally. In this example here, we might spend an extra $30 in commissions. But let me ask you this. Would it be worth a $30 monthly investment in this example to lose substantially less money, to lose on only 5 contracts instead of 20 when we are wrong? What is that, an extra $360 a year? Well, if we're wrong twice a year, we might save thousands of dollars each time. So we might literally, I mean, that's a good return in and of itself, right? I mean, we might pay an extra $360 in a year for commissions to save $6,000, $7,000, $8,000 in losses. So yes, we are paying a little bit more money in commissions. Wouldn't have it any other way. It's a great way to start reducing risk. All right. Oops. Wrong. There we are. Right back on track. All right. So question, what is layering? Layering is adding multiple credit spreads. Okay, you might want to write this down, over different time frames for 2 reasons. To bring in cash flow. Yeah, that's kind of cool. And most importantly, to help reduce the overall risk of our credit spread or credit spreads period, right? Credit spread layers, we could also write that as well. But adding multiple credit spreads over different time frames to bring in cash and to reduce risk. That's why we're doing it, okay? So a big part of making money is not losing as much, right? Well, that was pretty deep, wasn't it? Okay, but think about it. If you could take all your losing trades from last year, whether they're debit spreads, directionally based options, stocks, or other, and if you could learn a way to just simply take those losses and cut them in half, not make a penny on your winning trades, okay? Just simply cut those losses in half, where would you be? Okay. Probably pretty far ahead, right? I mean, that's true with virtually everybody. All right, so layering in index markets can be done on virtually any market, but does not work very well on individual stocks. Now, in a perfect world, these average times are between 20 days at options expiration or before options expiration, 30 days before options expiration, and 45 days before options expiration. Now, technically, we can enter our layered credit spreads anytime between 20 and 45 days before options expiration. So we can enter 21, 35, 37, whenever those opportunities present themselves. Now, we'll talk more about that a little bit later, but we're going to refer to these as recipes. Now, just real quickly, I don't want to open up spreads less than 20 days before options expiration, because the probabilities are not nearly as accurate. Okay, the markets can move. How do I explain this in a 10-second way here? The markets can move, let's say the same 80 points they might move 2 weeks prior, but it's going to cause a substantially greater percentage move based on our timed options expiration. So probability is not as accurate less than 20 days before options expiration. The reason that we don't want to open up spreads greater than 45 days before options expiration is there's very little volume and open interest on those spreads. So if there's very little volume and open interest, that's going to mean there's very poor fills. Now, one of the things that I'm going to show you on session number 2 of going into the March, the 5-week program, is how the bid and the ask is really an illusion on high liquidity markets. So we're not going to necessarily be buying on the ask and selling on the bid. I mean, we're not going to do that. We're going to be trading at the mid price all of the time. And we can do that on markets that have very high volume and open interest. So in a perfect world, okay, let me show you that again. By the way, we are not in a perfect world right now. We're nowhere close to a perfect world. 45 days before options expiration, we're going to open up a bull put spread and a bear call spread. In a perfect world, markets are going to trend sideways a little bit. We're going to open up a couple more spreads. In a perfect world, the markets will continue to trade sideways, and we'll open up a couple more, another iron condor essentially, 20 days prior to options expiration. Now, in a trending world, which is where we're at right now, that's going to look something like this. Okay, let's say that we're trending up, okay, like we recently have, right? So we're going to open up a bull put spread and a bear call spread. Market's going to trend up a little bit. We're going to open up a bull put spread and a bear call spread. Markets are going to trend up a little bit. We're going to open up a bull put spread and a bear call spread, and we might have to close. We might lose on one of our bear call spreads in this particular example. Okay, so that's how the trending markets work. But what we don't want to do is say, well, the markets are going up, so let's just focus on opening bull put spreads. Let's just focus on those spreads. Okay, are the markets really going up? Now think about that. In this example, or in the real world example, is the markets have gone up, and they may or may not continue to go up, right? So what we're going to do is take what I call a bullish approach, trade both bullish and bearish, and we're simply going to make adjustments as the markets move directionally. We're not going to take a directionally based stance at all on this. Now, do I trade directionally? I do. I have a lot of directionally based stock positions, some options positions as well. But that's a different hat. That's a different set of rules. Okay. By the way, this is a great hedge against a directionally based trading system. I always tell people you should have at least 2 tools in your toolbox, right? You should be a master at a directionally based trading system. Whether you're trading moving average crossovers or you're trading Tom's calendar system, great directionally based trading system, with options. You have a non-directionally based trading system, something like layered credit spreads that you're trading at the same time. Okay, diversifying a little bit, spreading risk across different strategies. Now, consistency is really the name of the game with any strategy that you're trading. Consistency is the name of the game. So, this really is the secret, right? Being right more than you're wrong, and then you can start increasing contracts and slowly start increasing your risk. So one of my previous coaching classes, I believe this is the one that we did last year. Here are some numbers. Okay, so we had various spreads for the month of March. We had various spreads for the month of April. Now, when we go through the 5-week coaching program, what we start doing, and this is going to be perfect on March the 20th for those of you that are registered, we open up our first layer that night. And then what we start doing is week number 2, we continue to open up layers and work on the discussion boards to open up layers even between classes. So by the time we're done with our class, we're going to have a nice little collection of trades. Some classes we have a lot, some classes we have few, kind of like this one, right? There just wasn't a lot of trades. Back in October and November of this last year, 2018, there was a ton of trades, like 20 spreads over 2 months. It was absolutely crazy. Now, you'll see something down here called insurance, open INS, right? Open insurance. We're going to talk about that concept in just a couple of minutes. But in this class, and we'll do the same in yours, we're going to tally them up at the end of the class, right? So we look at the profits. This is based on 10 contracts, 500, 450, 520, 450. Are the profits about the same, right? We don't have, on this total of $2,540 profits, we don't have one trade at a $2,000 profit and a bunch at 20, right? Is that consistent? Can we duplicate those numbers and make more money? Not really, right? That shows that you got lucky on one, and the rest are very consistent. So this is what I mean by consistency. We want to see all about the same. Same with our losses. We want to see our losses about the same as well. This case here, we don't have any losses. I'll tablet some examples from October and November where we did have losses in just a second. But in this example here, this was about an 8.6% return on investment, which is not too bad, right? A combined 8.6% return on investment for 5 weeks of stress-free. Somebody mentioned that here this evening, being stress-free with your trading. So, and that also included, which we haven't talked about, the insurance piece. Now, I don't want to tell you that we're always going to show an 8.6 return on investment or percentage return on investment for 5 weeks. When we did, in fact, let me just switch over to the tablet computer. The October-November time frame, which if we look at, let's just go over to the chart here real quick. This was a really crazy time in the markets. Let's go over here and just type in real quick, Russell. So if we go up to the top here, 1742, which is right around September 4th, yeah, it was, which is really the start of the October expiration period. Look at where the market sold off to going into November's expiration. We had about a 16% directionally based sell-off, right? Directionally based move on the Russell. The market went straight down. Now, we had about 20 credit spreads. We had a combined, I showed this on Tuesday to some of Tom's tools members that have been through my class already. And we had 2, 3, 4 adjustments. I'm going to show you one of the adjustments here in just a minute. We had 4 adjustments over 2 months, which is almost unheard of. I haven't seen that many adjustments in that short a period of time since October 2008. Now, the results were a little different because we had a lot of adjustments. So during that period of time, we had, before paying commissions, we had a combined 5.5% return on investment for those 2 months, right? So I'm kind of compare and contrast what different markets do. That's what, 2.75% per month, right? And somebody might say, yeah, it's not, hey, 5.5%. I mean, that's not very good, right? But yeah, but look at the markets, right? The buy and hold person would have lost 16%, right? What about the person that was wrong on directionally based options and kept thinking that there's support here and got stopped out and there's more support and tried to buy the bounce and there's more support and markets fell underneath? How much money would they have lost on a directionally based a bullish system and being wrong on market direction? Okay, my point exactly. So generating a 5.5% return on investment, which by the way I'm very proud of, in a market that is down 16% is exceptional. But how do we do that, right? How do we push those types of numbers in a market that's not very favorable? How do we do that? Well, there's two ways we do this. Now, I'd definitely write down this slide, guys and gals. Step number one is this. Step number one is proper order placement. Okay, proper order placement. So what does that mean? That's those goosebump trades. Very specifically, that means 92% probability trades, minimum probability trades that pay a 5% return on investment. So that's what that means. Okay, so again, minimum 92% probability credit spreads that pay a minimum of a 5% return on investment. So by the way, the average, I know I'm saying minimum, the average is, just right at like 92.5% probability with approximately a 5.5% return on investment. I mean, those are the averages, okay? So we're just right over the minimums. Number two, and by the way, that step's easy, okay? That one's easy to do. Step number two, solid money management. And I tell you what, folks, this is the most important part. This is where people mess up. They don't have a money management plan in place. They don't. And they'll open up a credit spread. They'll hope for the best. The markets will turn against them, and then they'll email in and say, hey, when should I close this spread? And if you have to ask, it's probably too late. Okay, the markets have probably already gone too far. Its trade's already blown up and lost too much money. So we have to be very proactive with our money management plan. Okay, now what does this mean? Very specifically, what does this mean? And I tell you, I debated, what do I show you tonight? Because I don't have a lot of time here, but I want to show you and give you a good insight of, really exactly what I do. Because I know some of you are making a decision that are not registered for March 20th. Do I hang out with Devon for the last time he does this class or not? So I'm going to show you. I'm going to show you anyway, okay? So solid money management. I'm going to show you, just talk about it, okay? It means two things, really. Number one is delta adjustments, okay? Now, this is buying spreads back, closing spreads back. Let me draft this out on tablet computer. Again, I love teaching with tablet computer because we can take questions and do this sort of thing with on the fly. Let's say that we have a bull put spread down here, okay? And it doesn't matter the strike prices, okay? What does matter is we opened it with a 92% probability and a 5% return on investment. We followed the rules. But what we did not know is that the markets were going to sell off. So question, when do we do something with that spread, okay? Well, I'll tell you when we don't do something with the spread. We don't do something with the spread when it's too late and the markets are down here somewhere, okay? We don't do that. What we're going to do is actually pay zero attention to this squiggly line, which is current market movement. We don't care about that. And I'm being very serious about that. We don't care about that at all. The only thing we care about are these numbers right here, okay? Well, more specifically, we care about this number right here. What does that number change to? So what we're going to do, this is when we open the spreads, okay? Now, you may want to write this down. We're going to close the spread and do something with it when the probability drops below 80%, okay? Now, this is using closing numbers. We're not using intraday data. This is when we're using closing numbers on the Russell. So when the probability drops below 80%, we're going to do something with the spread. which by the way is going to happen, way up here. It's going to happen way before we get to the danger zone on the spread. Now, one of the reasons that we're being very proactive in closing the spreads this early is we are trading a spread that has an inverted reward to risk ratio, meaning technically we are risking more money than we are positioning ourselves to win. I mean, it's just the nature of trading high probability. It has to be managed extra carefully, okay? It does, because our losses will be greater than our profits, okay? Which, by the way, is okay, as long as we don't have that many of them. Probability will show, positive results, okay? As long as we follow the rules. Now, if you've learned anything about me here tonight, you'll know that I don't like to lose money. So it's another reason that we close these at 80%. I don't like to lose a lot of money, but we're also going to do something else with these spreads, okay? And that's this. We're going to add insurance with our delta adjustments, because since we are trading an inverted reward to risk ratio, and we are putting ourselves in a position where we're going to lose more money than we are winning, is there a way to offset that? And the answer is yes. Now, back in 2008, I learned a lot when the markets tanked. I was pretty hot and heavy with credit spreads. I just started teaching these online layered credit spread classes. And the markets were selling off. And quite honestly, we got very lucky. And I looked back and reflected on those spreads and those trades, and I thought, gosh darn it, how do we add an extra layer of security, essentially? And so over the course of the next couple of years, I really focused on how do I buy insurance on credit spread layers. Now, I want to tablet the concept, and I'm going to show you a real one here in just a couple of minutes. But essentially what we're going to do is this, okay? If this is our market, let's just focus on the put side here tonight. What we're going to do is we're going to open up a bull put spread, okay, BPS. And this is going to have a maximum profit of some amount of money. Let's just say $500, okay, 50 cents, 10 contracts, $500. So what we're going to do is we're going to reinvest 100% of that credit. I'm just going to draft this out in red. We're going to purchase 2 debit spreads. Okay, I'm just put debit next to it. And we're going to allocate $250 for each of these spreads. Okay, now we're going to position these based upon deltas, based upon probabilities, so they get placed in the same spot every single time on every single trade. We're going to do the same thing on the call side. Now, as the markets move a little bit and we're able to open up a second layer, we're not necessarily going to open up new insurance. As the markets move and we're able to open up a third layer, we're not necessarily going to open up new insurance. I say necessarily because there is one time that happens occasionally where we have to open up an additional insurance policy or an additional debit spread. But if we have this market that sells off, okay, what are we going to have? We're going to have some spreads, and it's going to look something like this, right? This spread's going to lose a little bit of, the spread's going to lose a fair amount of money. The next spread's going to lose a little less. And the next spread is going to lose just a little bit, maybe none at all. What's going to happen with these insurance policies? Okay, as the markets are selling off, these are going to make a fair amount of money. They should. Nothing's 100%. They should make a fair amount of money, okay? And if they're positioned correctly, one of the two should always generate a profit before our credit spreads generate a loss. Essentially, we're putting on a seatbelt, right? When we're driving down the highway, we're reinvesting some of these profits. Now, let me show you something cool. Let's switch over. I know I'm throwing a lot of information out there for you guys, but I really want you to take a look at, what you're going to master in this 5-week class, because, honestly, only a little part of it is about finding high probability trades, because I can teach you everything I know about it in 30 minutes. And some of you might be asking, well, why don't you teach us that tonight? And the reason for that is I don't like showing how to fly the plane until you know how to land it, because you will get yourself in trouble. Okay, I mean, it's going to happen. You will get yourself in trouble. So here's the spread. Yeah.
Before you get too much into these different layers and such, now or by the time we're done here, Stan's asking if you can go over again how to calculate probability.
Okay, we haven't done that yet. You know what? Let's do that in a couple of minutes. With if I can modify that just a little bit, Jay. With let's just go find some spreads. Okay, how do we find 92% probability trades? And we'll
there are multiple questions coming in. As where is it shown? How is it calculated? Where
Got
do
it.
I see it?
Okay, I will. You know what, Jay? Then I'm going to take an extra step, and I'm going to show them kind of the old school method too, real quick. Okay, if that's all right. All right. So let's take a look at the insurance. Let's take a look at landing the plane here before we fly it. All right. So here's the spread. This was open September 4th. This was this last year, 2018. 50 cents. And this started the October credit spread layers. Okay, you see it October on the right-hand side. On the left-hand side, you see October 2018 insurance debit spreads. Okay, so the next position, which took place seconds later, was we open up insurance. Okay, we take these potential profits and allocate towards different insurance plans. Okay, now this is not technically insurance, but let me rephrase that. This is how I refer to them in my 5-week class as insurance spreads. But right now, I guess with you folks, I should say we're going to reinvest these into debit spreads, which is essentially going to be a proxy like an insurance policy. Okay. Now, markets move a little bit. There's another opportunity. September 6th, open up a new spread. We don't need to open up new insurance. Now we have more credit than we've spent on debit. And the plan, Jay, is as the markets move and groove here a little bit, is to open up maybe 1, 2, or 3 more layers without any additional insurance debit spreads. Okay, that's the plan. Now, Jay, do the markets always listen to our plan? The answer is very seldom, right? So here's what happened. The markets on October the 9th, and we can take a look at the actual date, the actual market movement there. It happened right here, right before the markets really started to tank, kind of build up here on this support level, is the probability dropped below 80%. So this is not me saying, hey, oh, golly gee whiz, nailed that one, right? But the probability on this particular day, I believe, was right at 79%. It dropped just a fraction below 80. I'll show you how to determine that in just a second. That called for us to do something with the spreads. So I want you to look at this. You know, here it is. The spread's at 1,580, okay? If we were to look at 1,580 on the chart, which is down here, by the way, the 1,580 is where the market hit the very next day, okay? But the market was up here at 1623, okay? 1580s is where that current spread is, doesn't matter. Okay, again, chart doesn't matter at all. I'm just showing you for a reference point. Probability dropped below 80%. We are going to close those spreads. Let's assign some contracts to them, okay? Let's say that this 80-cent loss is 10 contracts. That is $800 negative, all right? Now, the next spread is a 20-cent loss, 10 contracts. That one is losing $200. So, Jay, I have successfully taught our students how to lose a combined $1,000. All right? Yes, I will pat myself on the back. All right. Let's pretend this is the car, and we just wrecked it. We have insurance on our vehicle, right? We should. Now, what happens when we wreck the car? When we wreck the car, make sure everybody's okay, and we call the insurance company, and we cash in we start a claim, right? And, go through that process. Many of you have been involved with that, so you can relate to that. We're going to do the exact same thing here, folks. We're going to go over to our debit spreads, and we're going to essentially cash them in. And when we cash them in, these are the values. This 1510 insurance policy made absolutely nothing. The market did not move far enough for it to generate a profit. This 1635, 1645 insurance policy made a profit of $4.95. Times 3 contracts is roughly $1,500. Okay, so let's think about this. I need to grab my pen here. Hold on. All right, let's go like that. All right, so we on our credit spreads lost $1,000. All right, let's assign an emotion with it. That sucks. With our insurance policies, we've made, well, let's be specific here. All right, we have made a profit of $1,485. Now this is before commissions. Let's assign a motion with it. Can I put, there we go. He's going to have big eyes and, you know, really super excited. So let me ask you this. Okay, how many of you enjoy taking a $1,000 loss? Okay, I assume that most of you probably don't. All right, now I can't imagine anybody who enjoys losing $1,000. Have you ever been in a spread or a trade? Could be a stock, could be a directionally based option. I need to tone my voice down just a little bit so I don't lose it again. Have you ever been involved with a trade or investment where you're up against a fairly sizable loss and you just can't bring yourself to take it because it doesn't feel good? I mean, if you've been involved with the markets, I'm sure you have, right? Let me ask you this. Would it be easier to take $1,000 loss in this example if you knew there's $1,485 waiting for you on the other side? Would it be easier for you to actually follow the rules and facilitate those trades? I think the answer is yes, right? So it's one of the things that the insurance really helps you to do. Now this, by the way, was this is kind of a rare example, although 2 of our 4 adjustments during October and November resulted in making more money by being wrong than right. It is somewhat rare. It usually happens once or twice a year with our adjustments, and we usually have adjustments approximately every 5 to 6 or 5 to 8 weeks, somewhere in there. So even if this was only a $500 profit, right, would it still be easier to take a $1,000 loss knowing that we had $500 to help offset that? So part of making money is cutting down on our losses. So now, you know, Jay, hey, let's go back to our market direction here. Where do I think the markets are going between now and the end of the year? Have no idea. Don't know, don't care. We're going to trade bullish, right? Bullish and bearish, and we're simply going to make adjustments as the markets move directionally. And in this case here, if the markets move directionally and we're wrong, we still have an opportunity to significantly reduce those losses. So trading layered credit spreads, folks, is really about losing as little money as we possibly can, capturing those credits, making the most amount of money in the shortest period of time, taking the least amount of risk. So Jay, let's do this. Let's go over to the Tom's tools. Actually, you know what we're going to
do that. Andre was asking, what are the chances of your insurance spreads getting filled because they are so far out of the money?
Getting filled?
Mm-hmm.
Well,
what are the chances of your insurance spreads to be filled because they're so far out of the money?
Oh, you mean the actual trade getting filled itself?
That's the way I'm reading
our
it.
Account. Okay. Yeah, it could be read, I guess, as getting that confused with being essentially in the money in an options assignment, which is not going to take place. But getting these put into our trading account is very easy to do. And the reason I say that, in fact, Jay, let's just go take a look at this here real quick. Let me kind of work that into this conversation, if you don't mind, is let's start with the probability, and then let's talk about the probability of getting filled. All right, so 2 different types of probability. I mean, actually taking these trades and put them into your trading account. Now, on the options primer, I believe after tonight, Tom is going to email that out to you for those of you that are signed up for my March 20th 5-week class. I do use Thinkorswim. I'm not affiliated with Thinkorswim. I don't get paid if you use them or not. I don't care which broker you use. I use Thinkorswim, so I show you kind of what I do. You can convert that over to E-Trade or any other broker that you want. So with probability, I'm going to show you the old school way, and I'm going to show you the new school way, and then let's take a look at probability of getting filled, okay? So what I'm doing right now, is, now we're only 14 days to options expiration, but probability will still be about the same here, is my eyeballs are focused right where my mouse is at, okay, which is right here. This is on the delta column. Now on my option chain, I bid ask delta, open interest, and volume for a couple of reasons. Delta is going to help me with probability. Volume, open interest is going to help me with probability of getting filled. Okay, so if we have an option, okay, let's just scroll way down here, something like this. Okay, let's just round this number and say this has a 50 delta, right? Negative 50 delta. Puts have negative deltas, calls have positive deltas. Take the negative out of it, who cares? Okay, it just has a delta of 50 for this purpose. Now, if an option has a 50 delta, it has a 50% probability of going up and a 50% probability of going down, right? Delta essentially is probability. If we scroll down and we find a strike price with a delta of 10, okay, we have a 10% probability. 10% probability of what? We have a 10% probability of this market at 1575 trading below the strike price of 1500 between now and options expiration. Now, that's the glass, right, half empty. If it's half full, we quote it the other way. So if we have a delta of 10, we have a 90% probability of this market staying above, because it's a put, this price between now and options expiration. Now, if we scroll down, take a look at this, Jay. Here's a strike price, or delta rather, 0.08. 1490 is the strike price. Okay, so we have, let's just focus on convert this to probability of staying above. We have a 92% probability of this market, right? 100 minus 8, 92% probability of this market staying above 1490 between now and options expiration. Pardon me. So that's how we can find probability. When do we make adjustments? We'll make adjustments when these deltas close above 0.20. So if we were to open up this spread today at 1490, I'd watch this delta essentially every day at the market close. If that delta reaches 21, like this 1535, then we'd close it. Not once am I looking at the chart, okay? Looking at the probabilities. Now, so that's kind of the old school way of going through looking at these spreads. Now, what Tom and I did a number of years ago, and I want to show you this because it is ultra cool, is go back over to Tom's tools. We're going to go over to the home page. We're going to go down to Premium Tools, and we're going to go to Credit Trapper. Is we have built in how to find the spreads and how to find insurance and make adjustments on Tom's website. So if I were to go find credit spreads today, I'd click on All Credits, and I would click on Search, and it's going to go through all the strike price and deltas for me, and it's going to come up with some trades. That's what it's going to do. It's going to show me exactly what the credit is. It has some other information here as well. I don't need to, this is going to show combined probability of profit. We're going to look at probability based upon that short strike price. So I'm not, if I'm using this tool, I'm not looking at the individual probability. It will be greater than 92%. So in fact, if we look at the strike price here, 1400, 1410, and take it over to let's make sure it was on this is for April, which does not meet those rules right now. But if we were to look at an April strike price, 1400, 1410 is going to be, let's just test it out here real quick, right there, 92% probability, 0.08 delta. So it does it for us. Now, the really cool thing and the powerful part, in my opinion, about Tom's tools is because finding these trades is relatively easy. Protecting them is another ball game. And what I love using this tool for is to find insurance. We can click on Find Insurance, and we can go ahead and click on Search, and because we're going to be looking for initially 4 insurance policies, 2 on the call side, 2 on the put side, various deltas. And it's going to split out exactly which 4, and based upon the average credit that I receive, it's going to show me the number of contracts that I should be purchasing and for what price. And it does it incredibly fast. So the real power of this is when we go to make adjustments, that it's very easy to do. Okay, it's very, very easy to do. Now, the other question was, and I want to go back over here, just look at a basic option chain, is probability of getting filled, okay? Let me go back over to the March time because, or the March expiration here, and let's just scroll down. I want you to just kind of keep your eyeballs over here on the volume, the open interest. Okay, it shows us, how many people are trading it and have traded it. I want you to also keep an eye on the deltas. Okay, what you're going to notice before we even scroll down is these numbers are going to drastically increase as we start reaching that 8, 10, 12, 15, 20, 25 delta. Okay, so let's see if that is correct. Okay, let's keep scrolling down here. We're still at these zero deltas, 7,000, okay, 1,500, 2,800. A couple things you're going to notice here as well. The strike prices that end in 5 have nothing. The neighboring strike prices that end in 0 have a lot. One of the rules that we're going to learn next month is when we open up credit spreads, we're only going to open up credit spreads on the Russell with strike prices that end in 0. Why that end in 0? Well, because they have the most volume and the most open interest. Okay. Now that won't necessarily hold true for insurance, for the debit spreads. But I want you to notice this. Okay, look at these. I mean, 6,000, 2,000. I mean, we went from like 2, right, to thousands. Once we start getting into the ball game of where we're trading, we're going to usually be into about 1,000 contracts, somewhere in there. As we start going into this 20 range, okay, 17, which is one of the strike prices that we're going to look at for insurance, we're going to see a substantial amount of volume and open interest. So the probability of getting filled on these is very good at that mid price between the bid and the offer. If we can't, usually we might have to adjust it by a nickel or a dime, but usually we don't have to come off that price very much in order to get filled. There's a lot of activity on these options. Now, not so much on this because we're kind of in that crazy time frame, but as we get into the next a week, those April options will start falling in that 45-day time frame, and I want you to keep an eye on the volume and open interest on those. You'll start seeing them really start kicking up. What happens is volume and open interest on the front month falls off, and it goes to that second. All right. So again, there's a very, very scientific reason why we have the 20 to 45 days before options expiration. So exactly like that person who asked, so we can get filled on these spreads. Now, let me switch back over to my slides, and that's not what I was looking for there. Got too much stuff open. There we go. All right, so folks, for the 5-day coaching outline, here's what to expect. So week number 1, we're going to talk about the basics. We're going to talk about finding high probability trades. Week number 2, we're going to jump into layering, reducing risk, creating consistency. By this time, we will probably have 2 layers already open, maybe even more depending on the volatility of the markets. If the markets are like what they are now, we'll probably have more. Week number 3, we're going to jump into individual credit spread adjustments. Now, ultimately, this is going to move into session number 4, which is the all-in-one adjustment with insurance. But we're going to start out by making individual adjustments so we can start jogging a little bit before we really start running. It's going to seem like a lot when we have to adjust 3 spreads at first, but I'm going to present it in a way where we're going to do it piece by piece, and we're going to add on it. We're going to build to it. You might trip a little bit. I'll be there to pick you up, take you to that next adjustment, help you with that next spread, so that at the end of the 5-week program, what you're going to be able to do is simply pick up exactly where we leave off, and that's really my goal. Have 2 months worth of layers out there for you. 1 month will be closed, 1 month will be open, and have you just simply pick up where we leave off. Continue to use Tom's tools, which you'll get that as a bonus. You'll see in a second, and manage the spreads, looking at the probabilities, adding new 92% probability trades. Simply repeat, rinse and repeat those rules. So classes start on March the 20th. All the classes start at 5 p.m. Pacific, right, 8 p.m. Eastern. My classes average 2 hours. Now, Tom has asked that I go an hour and a half, and I've done, 5 or 6 of these classes for Tom here over the last 5 years or so. And I tend to go a little bit long. We record all of these sessions, audio, video. They're recorded just like tonight's class is and other previous classes that you've been to. It's very interesting because back in the old days, I used to teach this with Tom live. We'd do it at our advanced class, and I'd do it over a 2-day format. We'd have students travel all around the country to learn about layered credit spreads. And I'll be honest with you, it probably wasn't the best of ideas because the retention rate wasn't that great, or retention of the knowledge wasn't that great. And students would learn the information, learn how to layer. They wouldn't necessarily remember it all because I threw out a lot of information in a very short period of time. And we also didn't have the benefit of the market moving for 5 weeks, 6 weeks at a time, where we could actually make adjustments, actually communicate about different scenarios that are going on. We only had the markets open for a couple of days when we're doing it live. So doing these types of classes is a huge benefit to you. The cost drops way down, your knowledge retention jumps way up, and your experience level goes through the roof because of what you're exposed to in the markets. So with the recorded classes, we do, or Tom does, send these out immediately once the class is done, and gives you unlimited access to these to go through and review them as many times as you want. And what you're going to find is, as you go through these classes maybe 2 or 3 times, you're going to start hearing things in that second class you didn't hear on the first. And students will comment all the time and say, "Hey, Devon, I know it's a recorded class. I'm hearing exactly what you said, but I heard something that that I didn't think you said in the first class." It's because they start to get it, and that's really, been a huge success for our students. So, I can't thank Tom enough for making sure that we record these. Records the tablet. If I go over to Thinkorswim and place a trade, go over to Tom's tools and find a trade. Whatever the case, every single click that I do, the voiceover, it's all sent directly to you for review. Of course, the case studies, we are going to layer. It's what the class is all about. We are going to layer good, bad, or ugly. We're going to go through every single case study, every single insurance policy, and do it live, real time. You get to experience that. So also included with the program is the credit trapper scan. So Tom's going to make sure that you have that for the duration of the scan or of the class, so that you can find credit spreads 2 different ways. And I suggest that you take advantage of doing it the old school way a little bit to not only trust the software and what the software is showing, but also just to help with your knowledge and retention as well. And we do have discussion boards that we have active just specifically for you guys and gals. And this is one of the reasons that I keep my classes very limited is we're going to submit homework. I'm going to have you submit homework. First homework assignment is going to be to compare the Russell to another market. I'm going to give you instructions on exactly what to do. You're not going to necessarily know what to do with the data that you collect, but then on session number 2, guess what we're going to do? With all the data you collect, we're going to do something with it. We're going to build upon it. So all of our communication is going to be done via the discussion boards between classes. You get to a point where you're stuck and you say, "Gosh darn it, how did Devon find that probability with the old school method again?" Oh, I've got 2 choices. I can wait till next Wednesday's class, or I can type a note right now. And I will tell you this, by the way, type a note. Discussion boards sometimes are a little underutilized. Take advantage of it. And this is one of the reasons I like having these smaller classes, is because I like to have that communication with my students. And I don't want you to wait. I truly, sincerely want to be able to help you out and help take you to the next level, share my knowledge and information with you, everything I put together over the years. So a couple bonuses that we've put together is we're going to turn the 5-week program into a 6. And when Tom asked me to go on the year-end cruise that we did and give a talk to some of our students and had dinner with them, and had a number of students come up and say, "Hey, Devon, can you talk to me about this? Can you talk to me about that?" And I didn't really have time then to get into it. And I said, well, let's do it as a bonus session on my last March class. And so session number 6 is going to be this. And I'll start off by telling you that session number 6 is going to take place approximately 2 to 3 weeks after session number 5. We don't have it on the calendar yet. So as you get registered, you can have the sign up. You can see the 5 classes. Session number 6 is not on there yet. Don't worry, it will be. Okay. So what we're going to do After session number 5, you're going to have a handful of case studies on your own. You're going to manage those. You're going to do your delta adjustments, your all-in-one rollouts, insurance policies, everything that comes along with it. And when we meet up, the first thing we're going to do is go through those case studies that took place between then and now. This will be a great opportunity to kind of see how you're doing. And then we can pull up and see, if there was any case studies that you missed. Do you need any help in any little areas? And what students have told me is this really helps boost confidence that they are doing the right thing moving forward without me. So that's the first thing that we're going to do. The other thing we're going to do is talk about some of the voodoo stuff in the options world, and that is long-term investing alternatives, okay, some long-term investing stuff. I want to talk about the dogs, the Dow. Is it still a viable long-term system? The answer to that is yes, otherwise it would not be on this slide. How do I use it? How do I use it with other, mutual funds, low-cost mutual funds? What about some of this long-term stuff? Over the years, I've had hundreds of people ask me, hey, Devon, what should I do with my retirement account, my 401k, my Roth? I can't tell you exactly what to do, all right, but I can give you some ideas, and I can share with you what I do. And, especially with with mutual funds, there's a lot of good ones out there. There's a lot of bad ones. Mutual funds are not a bad thing, okay, if you do a little research and invest in, specifically low cost, right, mutual funds. There's a few of them, not a lot. ETFs, using exchange traded funds, things such as, VTI or VOO, those are ticker symbols for some of the Vanguard ETFs. Very, very low cost ETFs. One's a VTI total stock market index, and VOOs, essentially the S&P 500. How you can hedge those with some of the iShares like TLT or IEF, 10-year, 25-year treasuries. And so those are some of the things that we're going to talk about. I know, complete different subject, right, versus trading credit spreads, but it's incredibly important in your long-term financial outlook. And it's really where I've turned a lot of my efforts and my focus outside of credit spreads is the complete opposite, which is the long-term stuff. Nobody focuses on it. I mean, there's a huge market of people that just don't know what to do. And I'm also going to share with you one of my balance sheets where we take a look at assets and liabilities, and we list out our accounts and put together a risk profile, for ourselves. And I can't tell you where your risk should be, but we can talk about some generic risks on typically where they are versus, which age group you might fall into and how you can, change that moving forward. So basically what I want you to do is I want to, in this session, give you a good head start on how to become your own financial advisor, your own family's financial advisor. And, when people come up to me and, at cocktail or dinner, meet and greet with my wife, at her work, people come up to me and say, hey, what do you do? My answer is simple. I'm an investor. That is what I do. Trading layered credit spreads is part of my investing world. Okay. Real estate rentals is part of my investing world. Long-term buy and hold is part of my investing world. I am an investor. Okay, now I don't go through all those little pieces. I'm doing that for your benefit so you can see and understand. I want you to start thinking a little bit differently other than just saying, hey, let's just focus on just trading credit spreads. Okay, that's great. It's a great place to focus, right? But what I want to do is give you more. I want to challenge you to think about more than just trading options. Okay, I want you to think about the big picture. So anyway, that's a huge bonus, by the way, that we're going to be doing in this class. The primer video, okay, bonus number 2. This is going to be very, very critical that you go through this. Tom will make sure that you have this video, in your hands as soon as you register, or within a day or two, I should say, within registering for it if you're not already registered. We put this video together a couple years ago, and it's going to walk through the basics of credit spreads, individual options, rights versus obligations. It's going to walk you through how to place spreads, how to close spreads, how to adjust spreads in terms of making adjustments on the broker site. So I use Thinkorswim. You can follow the same format if you're using a different broker. The process is about the same, but I want you to see that process. lot of bonuses for you. Bonus number 3, 60 days of Tom's Tool package. So this is going to include not only my Credit Trapper scan, but a lot of other really, really cool things as well. You're also going to get 30 additional live webinars put on by Tom and his staff on various different topics that are taught during the afternoon market hours. So in addition to trading credit spreads and what I'm going to share with you, this is just a bonus on a on a bonus. And for those of you that are on the fence and saying, I'm not sure if I should do this or not, it sounds kind of cool, but I've taken classes before and it's just not my thing. So we put this together a long time ago, even previous to Tom and I, or Tom's trading room here. Back in the days of Optionetics, we had this no risk money back guarantee on my class. And the guarantee is this. It's a really good one. Sign up, attend the first week, the entire class, get the recording, right? Review it. And if you go through it and think, gosh darn it, it's not for me. I don't like Devon's style. He doesn't tell enough jokes. This is too boring. 5%, 30 to 45 day, 20 to 45 day trades with, you could be wrong by 20%, it's just not, for me. All right. If for some reason you decide that you want out, let Tom or Jay know, email support@tomgentile.com anytime prior to week number 2, and we'll give you a full refund. And no offense, if you don't want to be in my class, I don't want you there. Doesn't mean I don't like you. I just, want you to be happy and want you to be where you feel you're going to get the highest return on your money. Now, I'll tell you why we offer this guarantee. I'm be very honest with you. I've taught a lot of these online classes about this. I think this will be class number 34 or 35 that I've taught over the years of these 5 or 6 week, in this case here, series classes. The reason we offer this guarantee is very, very, very few people take us up on it. Most people go through this and wish they would have gone through it years and years ago. I really do pour my heart and soul into this. Just like tonight's class was supposed to go an hour, and look at where we're at now. This is what you're getting for free. So imagine what you're going to get when you pay. We're going to cover a lot of information, guys. Okay.
Hey, Devon.
A lot of information. Yeah.
Real quick, some people are typing in, and I needed to jump in here as well. Just a point of emphasis, folks, that date on that slide is not the date for week 1's class. Week 1's class is March 20th.
I made a mistake on that, Jay. Oops. Okay. All right.
They caught it. They know March 20th.
Okay. Right. Thank you, Jay. Hey, you have to make one mistake tonight, All right, but nonetheless, there, folks. Thank you very much, Jay. Nonetheless, if you're on the fence, please join us, hang out with us, and see if the class is for you. In terms of the price on this, years ago, Tom and I sat down, and I've got a great relationship with Tom, and he always consults with me on projects that we do together, and he asked me, Devon, where should we price this at? And I was honest with him. I said, Tom, I think, I put a lot of work in this, a lot of effort. I think that this should be priced, well over $5,000 myself. I don't do the pricing. He consults with me. Tom comes up with the price. And so what Tom is going to do for you, and especially since this is my last class that I'm going to do, talk about that in a second, but what he's going to do is discount the price of this now 6-week program with all of the bonuses for $1,995. Now, in my opinion, Tom, I think that this is stupid cheap, right? If you're questioning whether you should do this or not, this is price of a handful of spreads, profitable spreads. It's not that much money compared to what you're going to get. And I will promise you, it'll be some of the very best education that you ever get. Now, because we have the discussion boards, and I do highly, highly suggest, I can't make you, but I do highly suggest that you communicate on those discussion boards and post your homework and truly take advantage of what we're giving you. I do keep these classes limited small, and this is where Tom listens to me. I tell him what to do with or he tells me what we're doing with price. I tell him what we're going to do with the size of the class. So, I do obligate a fair amount of time between each class to go through and work with you individually if you need it. Okay, communicate with you. Look at the homework, not just say do the homework and let's grade yourself next week. I say do the homework, post the homework. Let me look at the homework. If I need to chat with you individually, I will. Going through the homework helps me adjust my class for next week. In most cases, I don't have my classes built until an hour before the class starts. I mean, honestly, because I build it based upon where you guys and gals are as students and where you are in terms of your growth rate. So we offered this a couple nights ago for a block of 25 students. I believe that's already filled up. And we're offering to the group that's on here tonight for 25 students as well. So, this offer will be good through March the 7th. I suspect we'll probably fill up in a couple, 2-3 days, somewhere in there. So if you were not sure, folks, take advantage, get signed up sooner versus later. And again, if you don't feel it's for you, don't cancel next week. Go through the first class and make sure it's not for you. And then, you can back out of it if you want. But for me, folks, this is, kind of a very bittersweet class. I've taught a lot of these. I've traveled around the United States, Australia, New Zealand, Singapore. Back in the days of Optionetics, I've taught a lot of live classes. I've had a blast. Getting a little bit older, got 2 young kids, 5 and 8 years old. Got one with a birthday party here this weekend, turning 5, little girl. And I like to do things with them. I like to take them RVing and fishing and camping and be involved with their school. And I've got a lot of other projects with just where we moved out to thinning forest and in our backyard. And it's getting more and more difficult for me to do these classes every year to give everybody my full attention. So, I've talked with Tom about it, in the last 18 months or so, and said, Tom, I think this is going to be it. I'm not saying this is the last class I'm ever going to do, but this is the last class I'm going to do in the foreseeable future. I don't have any other classes scheduled. Very well might be my last. I don't know. I don't know where the world's going to take me. But, I'm going to give my heart and soul here when we do this class, and I'm looking for a great group of students to really, finish off and make sure that I get you what you're signed up for, and then a whole heck of a bunch more. So, folks, there it is. Hope you enjoyed tonight's presentation. I hope that you all have learned something from it in terms of the probabilities, different mindset, everything else that comes along with it. This is just a sample of what we're going to really dive into and where we're going to live starting March 20th for 6 weeks. So, folks, get signed up. Tom, I'm going to turn this back over to you. And
yeah,
folks,
I got it.
Thank you very much.
And thank you, Devin.
Yeah.
Thank you. And one of the big questions that's popping up is the credit spread, the credit trapper. Guys, you get that. That's for life. Once you get that turned on, all you have to do is just maintain a subscription with us at Tom's Option Tools, no matter what type. If you can be the smallest subscription we have, and you can get that actually for life. So before I'm going to show everybody how you sign up for this. I sent a link to you a couple of times during Devon's session, and if you simply click on that link, it says tomgenta.com/19 credit spreads. That's going to bring up what you see right here in front of you, and you can read it over. It shows you everything that Devon had just talked about, all the classes. We're adding the bonus on there. We're going to take the 6 months access to recorded sessions, and we're going to double that. It's going to be 12 months. Case studies, your upgraded tools are going to include the new credit spread scan, which is called Credit Trapper. We have upgraded foreign access, so you could talk to Devon himself, in between sessions, and of course, live technical support. Then we've added on an additional bonus, which is our market alert publication, money calendars. You're going to get that for 60 days. Darknet. You'll get the trading tools as well. All of our videos, 100+ training videos that we have on, as well as our money back guarantee, which is a simple one. You just join us for week 1. Sign up, join us for week 1. You just feel like it's not for you, then before week 2 starts, let us know. We'll give you a full refund. It's that simple. If you read all this over, you click on the orange button, and that's going to actually take you to, it's just going to take you to a terms of service page. Read that. If you agree to that, click on I agree. That'll take you to our PayPal page. And you'll see here it has the deducted price here in the top right-hand corner, and you'll put your email address in. Now, if you use PayPal, you just put in your email or login and password, and you can pay that way. If you don't use PayPal, little gray button down here at the bottom, pay with debit or credit card. If you click on that, it's actually going to take you to the PayPal checkout, the guest checkout with the discounted price. And from there, simply fill the information out, click on that. As soon as that comes through, then you're going to get a welcome and confirmation letter. That will include the registration for week 1. It's going to include the primer too. So you'll already have the primer there on that welcome email, as well as information on the credit trapper button, tech support, form access, and everything else. So before I let everybody go, I want to show you something. So one of our long-term students, Devon, and you know him, you've worked with in the past. I'm going to give his first name is Brennan. He actually sent an email in, and I thought it was so cool. Jay had passed it over to me. I just want to show this to everybody. This is from Brennan. And this came in tonight. You can see Thursday, February 28th. Now it says 6:10 p.m., but that's Pacific, guys. So that was right. That was 10 minutes after 9. And it says, I just want to let Devon and all know after watching the last few webinars, I had a good breakthrough in understanding. I realized I've been thinking out in the box. These kind of complex option strategies that Devon and others teach are absolutely genius. And it just goes on, and he just talks about, what he's learned, not only in the last few weeks, but also with Devon's class as a whole. And so, Brennan, I want to thank you for that. Appreciate that. And this is just one of a bunch of people that were chiming in tonight saying, thank you, Devon. Of course, thanks to the entire team. But I just want to let you guys all know, if you're thinking about having Devon, looking over Devon's shoulder for the next 6 weeks, this email right here to us just less than an hour ago pretty much sums up what everybody else already knows. So again,
it does, Tom. And this is quite honestly, this is one of the reasons that has kept me going over the last couple of years, because Tom knows I've been just so incredibly busy, and hearing testimonials like that, students, how it really helps benefit them, is why I'm doing it again this year, just to be honest with you. So, thank you for sharing that, Tom. And it really, it's,
Devon, you
really
were
cool.
Last year you said that was it. And I go, come on, Devon, one more. This is the 5th year.
I know. We had to arm wrestle for it, and you won.
It's because I'm strong. No. Anyway, guys, thank you all very much. Thank you, Devon. Thank you, Jay. Thanks to all of you for attending. Again, we will have a special cryptocurrency bonus webinar in a couple of weeks. I'll be letting you know about that a little bit later on, probably within a week or so. We'll start talking about that, and I'll make sure that you have that information. I'll have a special report that comes with that too, that really kind of defines the basics of cryptocurrency, as well as trading, the new concept, which is secure tokens. We'll talk about secure tokens as well. You definitely want to learn about this, because this is going to become our life, folks. And so with that, thanks again to everybody. I'll have a recording out to you real soon. If you have any questions at all regarding what we talked about tonight, support@tomgentile.com. All right. Thanks again, everyone. We'll talk to you soon. Bye now.